Hello, and thanks for joining us. My name's Ian Stroud,
And my name's David Malone.
and this is Hyperland. So, David, I have one word for you today. That's banking.
Okay, all right.
So, half the audience are now rolling their eyes, and the other ones are throwing things about. It's back in the news. And
Yeah, which bit of the news is it that's bothering you this morning?
well, it started with there are 3 regional banks in the United States. The regional, they're medium-sized, and they've failed.
Yeah, well, I mean, one of them, Silicon Valley, they call it medium-sized, but it had 209 billion in assets.
That's quite a lot.
Yeah, I mean, it's more than you've got down the back of the couch.
In terms of assets, now, I would think assets means buildings and things, but assets in terms of a bank is the loans.
Yeah, pretty much. And a whole bunch of other things that it might have hanging around in the vault.
We were told it was a combination of social media, people spreading, oh, something bad's going to happen, and the fact that we can go online onto our bank accounts and we can go, oh, I'm going to withdraw all my money from this bank. So there was a run on that bank like we saw in 2008.
Yeah.
Okay. Then the next big thing happened was Credit Suisse.
Oh, okay. All right. Yeah.
Right. Now, they're neither in the States, they're not regional, and they're not medium-sized. There is, I didn't know about this, but there is something called GSIPs, which is the global...
G-SIFIs. Yeah.
The global system...
Globally systemically important
bank.
financial institutions.
Right, okay,
Yeah.
yes. And they're on the list.
Yeah, I mean,
there's about 20 of them in the world.
Yeah, I mean, and that is a really important. It's not a detail. I mean, G-SIFIs were an invention of the financial crisis.
Right.
They didn't really exist before then, and then when banks kept falling over, they said, "All right, let's sort out the wheat from the chaff here.
Yeah.
There's banks that we can let go, and there's banks that you can't."
Right.
It's like that line said, I'm the guy who decides that these are guys you can hit and these are guys you can't hit. Remember that? And there's guys you can't hit, and they're on the G-SIFI list. And the G-SIFIs, yeah, there's about 20 of them. The list was come up by the FSB, Financial Security Board.
Today we've got First Republic is now a sort of 4th bank that is trying to be rescued, and it's all this kind
It has been rescued.
Oh, it has been rescued.
Yeah. There's a bank that goes, oh, I might need some help. And then there's the bank that's collapsed. And in between, there's banks that needed some help and got some help.
Yeah,
and we now
right.
don't know. And they're in the middle bit because they have 11 other banks chipped in to save them because they don't want... First Republic isn't a G-SIFI, but it's not the kind of bank that you can go, well, it doesn't matter.
Yeah.
So, I mean, they actually got 70 billion just from JP Chase.
Oh.
JP Chase aren't going to give you 70 billion just on a whim, just because they like your face. Oh, go on, Ian, here's 70 billion. No, that doesn't happen.
But the other important thing is I overheard a conversation with you and a friend, Jonathan.
Oh, Jonathan, yeah.
And I overheard you sort of saying, this is 2007. All over again. Now, I was like, oh, David, we all know the crash happened in 2008. So what am I missing here?
Okay, well, for those who don't know, that's Jonathan Sugarman, who I've known since 2007. He was one of probably the most famous of the financial crash whistleblowers. He was risk manager at UniCredit in Ireland.
Yeah.
And without wishing to annoy too many lawyers, all the big banks, certainly all the big European banks, have branches in Ireland because I think it's fair to say that
there's nice tax breaks, is it?
Oh, very nice tax breaks, but also if you talk to bankers in Ireland, and I talk to quite a lot of them, they will all admit once they've had a drink or two, yeah, it's the Wild West here. I mean, basically, for instance, most German banks, well, all German banks virtually had a branch in Dublin because you could do trades in Dublin,
Yeah.
which the financial regulator in Germany said you couldn't do.
Nice.
It is illegal in Germany. You can't make that trade. So what you do is, and what they did do, and what they're still doing, is you have a branch of your bank in Ireland,
Yeah.
and then Hans gets out of bed in Frankfurt, kisses the small Kinder on the top of their head, gets his briefcase, goes to the airport, flies to Dublin, books the trade that would be illegal in Germany, but does it in
And we can say this
Dublin.
without getting sued.
Yeah, no, it's
okay.
true. And then flies back and has his knockwurst in the evening, and all is good.
Yeah.
So Jonathan lives in that world, and we've known each other for a long time.
So the connection to, we're now 2023.
Yes,
And
so
you're describing it as 2007.
Yeah,
and
well,
I'm a
because
bit-
Jonathan and I chat regularly, and when this all started, the regional bank started falling over. Jonathan was on the phone going, "Oh, they're doing it again." And I said, "Yeah, okay." So the reason I talk about 2007 is the 2007, 8, and onwards banking crisis started in 2007 when PNB Paribas had to close 3 pretty gigantic subprime funds. And that happened in 2007.
Right.
And the ECB pumped in, I forget what it was something like 70 or 90 billion overnight.
Yeah.
It didn't work. And then the Fed put in an enormous amount of money. The ECB put in a truly bodacious amount more money.
Yeah.
And I think the Japanese central bank put in a whole lot. And there was, I mean, it was probably around 200 billion, something like that.
Yeah. And that quietened it down in 2007.
Well, yeah, everybody held their breath and thought, shit, maybe this has worked.
We got away with it.
And then it didn't. Because then banks started falling over and we had a run on Northern Rock.
Yes.
So the reason that Jonathan and I were chatting about this and saying, yeah, this looks like 2007, is that you have that moment where something has gone wrong.
Yeah.
And the people who you suspect know why it's gone wrong aren't saying anything because possibly they're at fault.
Well, I used to do that as a child if I did something wrong.
Yes.
It's about going into a different room and just being very quiet.
Yeah, and then when you get
nobody
caught,
notices.
Yeah, and when you get caught, you go, yeah, well, it was like that when I got here,
Yes.
but I'll help you fix it.
It was him.
And that is essentially what is the next step in
Right.
the banking fallout. So some people, I think, must know what's happened.
Yeah.
Or at least have a clue. I'll tell you a little story about why they might not know, and why they're not going to tell you. And then people like the regulators, I think they don't know. They don't know what's going on.
Tell me the little story, and then we'll get on to. I mean, my basic.
Okay, I'll tell the little story, and I'm not going to give you any of the names because then I would get in trouble, and so would the person who told me. But this isn't a third-hand story.
Yeah.
This happened, and the person involved told me. So,
Brilliant.
This person worked for a bank and was another risk manager. I talk to a lot of risk managers because they're the people at the sharp end.
Yeah.
And person as a risk manager in the book gets taken in, so this is your job, this is your desk, here are the books, your job is to make sure that it all works by the end of the day so that we meet the capital requirements, so that at the end of every day you can sign off and go, yeah, the bank is solvent. There's all our liabilities, there's all our assets, they match.
And this is all regulated.
And written down.
Legal, and it's...
And this particular bank had a branch virtually directly opposite the regulator, okay? And so the risk manager said, okay, great, this is fabulous, this is what I'm going to do. And then the person who'd hired this risk manager said, there's one other little detail. If you see the bank regulator come out of the office and head this way, I want you to take this book and put it in that safe,
Yeah.
and then get a book that you'll see that looks very like the book that you got in your hands, get it out and show the bank regulator that book,
Okay.
which is our fake bank records. So there were two
Yes.
records. There was what was really going on in the bank, and then there was a parallel set which the risk manager had to keep up to date, which had the fiction,
Yes.
which would be what they would show to the regulator should the regulator suddenly pop over for a look.
Yeah.
Now that, I have no reason to think that the person who told me that story wasn't telling me the truth.
Yeah.
And I actually was telling that story about 6 weeks ago to someone else who used to work for a big British bank. And I thought I'd just tell him because we were having a drink and a chat.
Yeah.
And I sort of thought, well, I'll just check out this story again. And thought, well, there's always the possibility he's going to go, oh, that's just bollocks, isn't it? I mean, yeah, it's one of those
Fairyland.
fairy stories. You hear it going round and round, and it's just, I hope you don't believe that. And in fact, he went, yeah.
Yeah, that happens.
And this fellow used to work for a very large British bank. And he wasn't appalled or amazed or sort of chuckled. He just went, yeah.
But then, I mean, you wrote, after the crash in 2008, you wrote Debt Generation, which is available on all good bookshops.
It's only available on Amazon now, I think. And I would like to put a shout out to my old colleague, Mark Tanner, because he deserves really the credit for that book.
Yeah.
I just wrote the blog, and it was Mark who said, I want to turn this into a book. And he did all the work.
So all of these they're not in the book, but these stories are between 2008 and 2010 or post 2010?
Yeah. I mean, there were lots of things that I decided not to put into the blog because people get really litigious and
Yes.
unless you've got, and even if you're in the right, if they decide to take you to court, you're going to lose because you can't stay in court that long.
Yeah,
So there's lots of things that
they go around. I mean, that's going into the next thing, which is we kind of know after the crash and the fingers were pointed and people looked into it. And as Joe Public, me sitting here, I listened to what people were sort of saying, and okay, yes, it's been sorted out. We've found the people, but nobody really.
Oh, I mean, it's the most sorted out crisis ever. I could think of at least half a dozen times it was sorted out.
Yeah.
It was sorted out before it began. I remember old Hank Paulson saying subprime is contained. I'm pretty sure it was Hank. It might have been it might have been the other fellow, not Gethner, whatever his name was. And, it was contained until about the next morning when it most definitely wasn't contained.
Yeah.
And how many times have we heard that? It's always contained. It's always no problem. I mean, didn't they say that just recently about where we started with these, and they were saying, oh no, this is all contained now. It's going to be fine.
Well, yeah.
And Credit Suisse was saying just before, I mean, literally a day or two before, that no, we're fully capitalized and we're fine, and then they're not.
They've got to say that, or they get a run. And this is the,
okay. Well, let's get to this run business.
Yeah.
Okay. Look, yeah. When Northern Rock went down, that was a genuine bank run because Northern Rock was not a big player. It was essentially a high street bank.
Yeah.
All right. They'd been doing stupid stuff with securities, but they were a high street bank. They weren't
general
one of
speculating, investing. They weren't.
They weren't a massive player. Yeah. They weren't the creators of the problem.
Yeah.
But
they were playing.
And
the game.
that was a genuine bank run when a lot of their depositors started taking out money. All right. Now, Silicon Valley Bank, when there's a run on that kind of bank, it isn't. It's not like word gets around in the local taxi companies, and every taxi driver turns up and says, "I want my money out," and the bank collapses. It just, imagine, 209 billion. Imagine how many taxi drivers it would take. Well, there'd be a line that would stretch right around the world several times for enough. So it's not ordinary people on social media. I mean, social media is a powerful thing, but if you and I put out a rumor on social media tomorrow saying that the Fred Fanakapan Bank is going down, I don't think that's going to snowball and suddenly the bank's going to collapse.
No, I think a few people would get a bit worried.
Yeah, maybe. But it's not going to be enough for a bank run.
And I'm going to go, the regulators are covering me for more than I've got.
Okay, that's another thing which we'll talk about. God, you're making this difficult.
Thank you.
So it's a bank run of bigger players, who aren't just on. They didn't get up in some big company and say, you know what, I'm the risk manager in this multi-million-pound company. I think I'll check Facebook and see what they're saying.
Yeah.
No, it doesn't work that way. Oh, look, Tom on Facebook has said. So
there's something else behind it.
Yeah, they know from what's being said in the financial markets
Yeah.
that something is going wrong. So yeah, it's a bank run, but it's not just mum and dad going, oh, I'm a bit worried. I've read on Facebook. It's not that kind of bank run.
Right.
This is big players who know some inside stuff. And
Yeah.
it had to do, what we know it had to do with at least, was probably the value of sovereign bonds.
Right.
So
yeah.
there was something going on in the bond market. Then you've got people like Silvergate and Signature Bank, and
Yes.
everyone always points the finger at crypto. It's like saying someone had the cooties.
Yeah. Oh, I didn't hear much about crypto involvement in that. I mean, there's
Well, they're pointing the finger at it now, and I'm sorry,
okay.
but that doesn't wash either. And Credit Suisse certainly weren't brought down by Bitcoin or anybody else's.
No,
coin.
I mean, Credit Suisse have been in decline for a large part of this year. I mean, the people, the big, like you sort of say, not me investing my 20 quid. It's been large investors have now been pulling out and going.
Yeah, and I've read various articles where they say things like, well, they've been in trouble for a while because they were involved in scandals, and then there was some problems with management. And I'm sorry, but banks the size of Credit Suisse don't collapse because of scandals.
Yeah.
Because every bank that I can think of that's the size of Credit Suisse
Have
has been in so many scandals.
Yeah.
I mean, look at Deutsche Bank.
Yeah. Well,
Deutsche Bank has been continuously in trouble with money laundering, with dodgy deals done in Russia.
yeah.
HSBC has been brought up on one money laundering investigation or another
I think I've heard,
for as long as I've been alive.
I think I've heard pretty much all big banks.
Yeah,
at some
every single
point
one
are
of
in the
them.
news,
Yeah, so they don't
and they're
collapse.
large fines that they get, but
Large fines.
large fines to me.
Yeah, all right.
No, but
I know
think-
we're going off tangent, but I can't
Yeah.
let that one go.
No,
Look,
but it's a perspective thing. You see, I'm looking at it and going, "That's a huge fine."
yeah, it's a huge fine for you, mate.
Yeah.
But look, I'm not going to mention the bank or the particular issue because I'd have to get it exactly right or I'd be in trouble. And
Yeah.
I can't look it up right now. But the bank I'm thinking of, one of the big banks, was a big money laundering case, and it was a big old fine. And I worked out what the fine was as a percentage of the estimates of how much that money laundering escapade had made for them.
Yeah.
And it worked out somewhere in the region of 1/1500th.
I thought you were going to say at least a fifth or something.
No, but that's my point. So to say that the bank was fined, yeah, of course they were fined.
Yeah.
But that would be like saying that the five of you slip to the doorman at your favorite nightclub so
Yeah.
that you can jump the queue and get in is a fine.
Yeah.
And it's not a
No, it's
fine.
not.
It's the fiver that you said, here you go, Stan.
Let me in.
And yeah. And he goes, sure, Ian, in you come, mate.
All
That's
right.
not a fine.
All right.
That's
Okay.
business.
I've taken you away from
So
things
sorry,
by,
but
by, by,
that just irritates me. This banks have been fined. Shit.
Well, okay, so right, we're now 2023.
Okay,
so
yeah.
you're is there a prediction now saying 2024 we're going to have another crash?
Well, some people are saying that. I don't know enough to say that, and I don't
Right.
think anybody else. I mean, don't forget, I am not an expert on banking or anything else
but
in
it's
the
a
world.
discussion about
So I have very little inside information. There are a few people who talk to me, but compared to someone who works at the Financial Times and can say, "Look, I'll pay you 500 quid if you tell me,"
Yeah.
because financial journalism works that way.
yeah.
In fact, almost journalism works that way. So if you've got
I'm so wet behind the ears, mate.
most stories, they're paid for.
Yeah.
Someone says, "Yeah, I've got this. I'll tell you what's going on, but I want some money." And I'm not saying there's something wrong with that.
No, it's business.
I actually
yes.
think there is something slightly wrong with it, but I'm not saying that.
Okay,
I didn't
yeah.
say it, in fact. You could erase that bit. But sorry,
Back to the
I've never
point.
come across two people who can spend so much time not getting to the point. But some people are saying there's going to be a crash. I don't know. I don't. What I do think though is that just like in 2007, something happened which ought not to have happened, and it wasn't small.
Yeah.
Okay, when Silicon Valley Bank, 208 billion, yeah, it's pretty big, but
Throw in Signature, throw in Silvergate,
yeah,
throw in
200
First
billion. I mean,
Republic.
back in 2008, 200 billion was big news.
Yeah.
These days,
Okay.
I'm not sure I'd get out of bed for less than 300 billion. But Credit Suisse is a different thing. And then you have to say to yourself, look, are they unrelated? That Silicon Valley Bank goes down, Silvergate, Signature Bowes Bank, First Republic is wobbly, has to be lent 70 billion by JP Morgan Chase, and then Credit Suisse.
Yeah.
Are these all just unrelated?
Well, I'd sort of say
maybe,
no.
but I don't think so
Yeah.
either. And I always think of that. There was a great scene in The Grapes of Wrath,
Yeah.
Steinbeck's novel,
Yeah.
and about how unscrupulous car dealers at the time, desperate families need to get out of Oklahoma and drive to California. And they would buy these terrible old broken down cars. And what they would do is, and don't forget these are 1920s, 30s cars, they would put sawdust in the transmission so that as that sawdust got mulched up, it would kind of work. It was some kind of cheap lubricant. The cogs would sort of, but it's sawdust, for goodness sake. And they get 10 miles down the road and they were stuffed. And I just feel that that's what happened in 2007. It's what I think is happening now, that the system isn't working and they don't know why not. But if they just say, if we just take 200 billion and stuff it in there,
Well, there's a lot
then
of plasters.
it just keeps turning for a while. And then when it doesn't turn, we'll stuff some more in.
A bit of gaffer tape.
Yeah, gaffer tape. Yeah. And why does this keep happening? We've got. I think part of the problem is we've gotten so used to it that people go, "Oh, it's a bank collapse," as if
It's a normal thing.
Yeah.
Yeah, well, it's to be expected. But okay, so take me back to who's controlling this? Central banks. Well, ECB came along.
Central banks don't control anything. There's this notion
Fed.
that central banks, Fed, the ECB, that they control things, and then the private banks respond to that. Because the central. That's not the case. That really, truly isn't the case.
Right.
The people who decide how much money is in the system are the private banks, and they will keep issuing loans, which increases the amount of money that's around.
Yeah.
And then at some point, the central bankers have to respond to it. But it's always the central bankers who respond. They bring in, their bank term funding program, which is the latest one. That's what the Fed brought in to give 1-year loans after Silicon Valley, Silvergate. I don't know if they brought it in before First Republic started to wobble, but I think it was in response to that one as well.
So, yeah.
But the central banks respond to these things. It's not that they've set things up and then that's the world that the commercial banks live in. It just doesn't work that way. The central banks aren't in charge, but they are the people who have to temporarily fix when it all goes sideways.
Yeah.
And the thing is, I take issue with central banks. I've got real problems with this whole idea of central banks.
Yeah.
And my apologies that the longer this discussion goes on, the further away we get from the place we said we were going to get to. It's like we're marching backwards to Christmas here, but never mind. People talk about, isn't it wonderful that we've got independent central banks, and thank goodness that's, we've got these things. And I want to say, independent from whom?
Well, they're independent from the government, so therefore what they're saying is the government can't interfere in their own little picky way, and then the next government comes in and they change everything. And
sure,
so I can see a logic behind it.
Sure, so can I. Yeah, I mean that as an argument actually works and it's true that governments are very tempted when they've been screwing things up terribly that they go, oh my God, there's an election in 6 months. Right, I tell you what. Phone up the central bank, tell them to give everyone a loan, lower interest rates, make it all rosy for 6 months so that everyone's forgotten the previous 4.5 years, and then we'll get re-elected because then we'll go, I'm feeling great.
Yeah.
Sure, of course that has happened. And so So then the idiot's answer, and I do think it's idiotic, is to say, let's make banks independent from politicians. Okay,
Yeah.
fine. That's another way of saying, let's make central banks not have to listen to the people who we've elected. So it's removing, in a way, public ownership and oversight over the currency which we depend on. Now, you could say that's fine. If you believe that the only negative influence that could possibly impinge on a central banker
It's the government that we vote for.
is unscrupulous, shallow, slightly corrupt public officials.
I'm not going to answer that.
then this is a great solution. But is it? Is that the only influence there could possibly be? No. Wouldn't that be ridiculous?
Yeah.
All of the commercial banking sector and all the non-banking sector is going to influence those people. So all we've done is set up a whole series of central banks that are isolated and insulated from the public, and the people that they're not protected from influence from are all the commercial banks and all the people that they went to Eton with.
Right. Yes. No. I see
Or
that.
Groton or Harvard.
When did the sort of this central banking come into play then?
Well, you mean the independence of
Yes.
them? That would have been in the late 80s, I think.
Right.
It was people like Gordon Brown, etc.
Yeah.
That said, oh, we must have them all independent. And it's not that I think they should be at the beck and call of thick, unscrupulous and crooked politicians. But I do think that pretending that central banks are in some godlike way.
Yeah. I'm just looking at the facts and the figures and doing the best.
For everyone.
Yes.
Well, if they
everyone?
are, isn't it an amazing thing that while they've been trying to help us all out equally, the 1% have become stupendously rich, so much richer during this extended banking crisis, and the rest of us have got poorer.
Yeah.
Gosh, what an amazing coincidence.
So, okay then. So
anyway, I just had to get that off my chest.
regulation. So who is? I mean, do we need more regulations?
No, we don't need more regulations. What we could do with was actually enforcing any of the regulations that we currently have.
So the
We've got more. You could choke a donkey with the amount of regulations we've got. If you hit a horse over the head with the book of our regulations, it would be dead as a doornail. But we don't enforce them.
Yeah. Okay.
There you go. I'd love to say more, but it's not more complicated than that.
Yeah.
Do you know no bank has ever been prosecuted for money laundering, not criminally.
Yeah.
It always is that, oh yeah, money was laundered through the bank, but we didn't do it. And we've got hundreds of pages of anti-money laundering regulations, and yet in excess of 300 billion is laundered from drug money every single year. Every single year.
Can I ask you another hard question?
Yeah.
Where do we go then? Where do you go?
What do you mean?
What is wrong and what is going to stop the every 8 to 10, 12 years we seem to be hitting
Well, I'm glad you said that.
wall.
Yeah. I mean, that's another thing that's worth just reminding ourselves of, is that from the Great Depression through the 70s, we really didn't have financial crises.
Yeah.
There was the oil shock of the 70s, but that wasn't a financial crisis. It caused the financial crisis, but it wasn't caused by banks.
By the
It
system.
was caused very reasonably by the oil-producing nations saying, we're slightly sick and tired of you telling us how much our oil's worth and being in control of it. So you know what? I think it's our oil. It comes from our country. We'd like to set the price and it's going to be a bit higher.
Yeah.
Okay, that's not a banking crisis.
No, I understand.
But once you get to the 80s, and when you got to the big switch on in 80, what was it? Was it 87 when they connected up the global markets? From about that point on, America on its own has generated and exported a financial crisis. It's about every 9 years.
Yeah.
And the thing is, when talking of bank runs, when the US financial system gets the runs, the rest of us always get covered in shit. It's just the way it is.
So what's the answer? Well, I'm not expecting the answer, but what should we be looking for?
Okay, there's several. There's not one easy thing, but there's lots of things we could be looking at and we haven't looked at. Part of what I think is going on in this recent bank ups and downs, and I would like to say that it's not unrelated to the old Liz Truss quasi-Kwarteng mini budget. These things aren't all unrelated.
Yeah.
They are related. And part of what we need to do is look at trade in bank risk, for instance. I mean, one of the big things in 2007 and onwards is people said, okay, the banks have to be less risky because they keep falling over.
Yeah.
And there's various ways you can do that. You can shrink the bank. You can make them only engage in less risky trades. You could outlaw certain kinds of credit default swaps and derivatives and all the rest of it. But nobody wants to do that.
Well, but if they did do that, they'll just go to Dublin and...
Well, okay, fair enough. Or the City of London. Well, come on.
Meow.
Yeah, the City of London's not the Wild West. It has tablecloths and silver service, but it does the same things. Don't you believe it doesn't?
Okay.
But for instance, what happened, and this, I'm not saying this is the whole answer, it's just part of the answer. It's one of the many things which we ought to be looking at. And it ought to be more in the financial news that we're all being given so that we can think about it. Is you had things like, you have trade in things like regulatory capital relief or liability-driven investments.
Yeah.
The LDI trade is very much wrapped up with what's been happening with our mini budget and whatnot. But essentially, you've had a lot of trade. Let's take the regulatory capital relief trade. Banks have risk. They're making these loans, and whenever you make a profit, you're going to also see risk, because essentially it's by doing something risky that you get the profit. Okay, so risk is like the inevitable pollution of an industrial process.
Yes.
All right, but then you can make a lot of trade by trading in waste. And so what's happened is the banks want to continue having their risky trades, and the regulators said you need to be less risky. So rather than stop doing the risky trades or stop owning the bit of paper of a risky loan, what they've done is they've said, we're going to keep this risky loan, but we're going to sell the risk. We'll keep the loan, sell the risk. It's just basically like insurance.
Yeah.
There's risk your house might burn down. Rather than avoid the risk of your house burning down by saying, if I don't own the house, if I don't have a house, it can't burn down. No risk. You think, but I want to live in the house. So then you say, well, let somebody else take the risk of it burning down. That's called insurance. Okay. Yeah. And so what they did is there was a whole big trade in banks selling the risk. Someone else would take the risk.
Yeah.
The bank would pay them a fee.
A premium
and
for
then
it.
if something terrible happened with this risky trade, the other silly sod would pay it out. Well, guess who took on those? Insurers. But the thing you have to remember is insurers are often your pension companies.
Yes. Yeah. Oh,
and
right. Okay. Yeah.
they're not regulated in the same way.
Okay.
So basically, when I say, oh, it's just insurance and they're buying insurance, that makes it sound like a great idea. But the other way of saying the same thing is that you are taking risk that the regulators can see, because this is where the regulator is shining his torch, going, I can see the risk.
Yeah.
So you distract them for a second, and then you sell the risk to somebody else who's standing where the regulator's light isn't shining.
Yes.
And they look at it and they go, oh, look, your risk has gone up. You're much better.
Yeah.
And they're not noticing the risk piling up elsewhere. And it was piling up in insurers and pension companies. So it's not the only thing going on. And I'm not saying, but there was a lot of ink spilt at the time. And people were saying, oh, this isn't really being regulated, And then guess what? When Kwasi-Kwarteng makes his announcement.
I was going to say, so that's the reason why.
That's why I'm raising it, is wasn't it weird that some small offshore island wants to raise a bit more money?
Yeah.
And just the mere mention of it, and the next morning we have headlines saying pensions at risk.
Yeah.
What? Wait a minute. Where did that come from? Why were the pensions at risk? What did that have to do with anything? He hadn't said, I'm going to asset strip pension companies. So my point is that something was going on in the financial system.
Yeah.
And when he said what he said, and then there was a run on gilts, so but the value of these things
Yes.
changed, that it's the pension companies that are suddenly in the spotlight. And they're saying, oh, we're going to have to do some bailouts,
Yeah.
we're going to have to commit some more public money to this. We're going to have to get rid of your duly elected officials and their plans. Can't happen.
Yes. Yeah.
Now,
I think that was probably one of the first times I can remember where the government sort of said, right, we've set out this new budget, and the chat at the time was like, oh, well, you didn't warn everyone first. And that's why it was such a calamity.
well, I mean, yes, I suppose they could have said, look,
Well, tomorrow we're going to do...
could have called them in and said, look, we're going to say this, chaps, and you need to do something about it. We're going to give you longer to sell. Maybe. I'm not sure that would have made much difference. But my interest in it is, as you said, it's suddenly you've got this notion where an elected government has a plan.
Yeah.
And the reaction in the financial markets is such that it's not just that they go, well, we don't like that plan, but okay, you're the elected government. They go, we don't like it so much that it's going to cause such a rolling catastrophe in the markets that it can't happen.
So this goes back to your debt generation book. There was a quote that was either in the book or in a quote from it, which was about the nation being saved by sacrificing the market.
Yeah.
And whereas now we seem to be sacrificing the state or the country to save the market.
Yeah, I do think there has been that inversion of power. It seems, I don't see how you can say that that's wrong.
Yeah.
It seems to me that's self-evidently been the case, clearly the case since 2008.
Yeah.
Or 2007. And I think it's gotten worse, and it links up with our point about central banks, because another one of these things is central banks are great because you have continuity of policy. So, instead of to burlesque the situation where you've got, you vote in a government and the government says, yeah, we're going to build a bridge. That's what we should be doing as a nation. And so they start building the bridge, and then there's an election and you elect a new government, and the government goes, we don't like bridges. Bridges are rubbish, mate. What you want is a velodrome. And so the bridge is now half built, not going in. A lot of money's been spent on it, but it gets cancelled and they start building a velodrome. And then there's another snap election and they go, velodrome's a shit, mate. What you want is a swimming pool. So now you've got a half-built bridge, a velodrome that's only got half a track on it. And then they start do a swimming pool. And then there's another election, and the people who like the bridge, they're back in, no, let's go for the bridge. And so now you've got, a two-thirds built bridge before the next election that stops it again, a half-built velodrome and an empty swimming pool. And so people say, okay, let's do away with that. Let's have some sensible technocrats in the bank who say, yeah, you people can come and go, but we're just going to keep the ship steady. When you put it that way, it sounds great.
Yeah.
But it also means that you could elect a government which says, we think this system is going radically wrong. We want to turn at right angles because the way you're marching, you're headed right for a cliff and you're going to fall over it.
Yeah.
We're turning away from the cliff. And the market goes, no, we need continuity, mate. And we're the market. We're bigger than you. And several of us are going to throw all the toys out of the pram. And suddenly you can't do that. And so I then start to think, what's happened to democracy? Democracy is now being shoved in a narrower and narrower track.
Yeah.
You can vote for any government you like, and you can have any policies you like as long as they fit in this narrow track. It's like old Ford. You can have a car in any colour you like as long as it's black.
As long as they do what the markets tell them to do.
And so
or they're acting within those boundaries.
Yeah, and it's easy to say, yeah, but Kwasi Kwarteng and Elizabeth Truss, they were idiots, and I didn't like what they had to say anyway.
Did you think they were right then?
I don't know, but for different reasons. But all I'm saying is, imagine you did like them.
Yes.
Or imagine, we're both slightly left of centre, I think. I know I am. I think you are.
Yeah.
And the libertarians who might be listening to this, we shouldn't hold it against us, because it's not like either of us are saying this is the answer. It's all in Das Kapital. No. It's not. But my point is, imagine if some left-wing president or prime minister had been in.
Yeah.
So someone
And
you
wanted
did
to
like
do-
and
I
wanted
mean,
to
it's-
do something, and then the market said no to that.
Yes.
So don't sort of rub your hands in glee and go, yeah, well, I didn't like quasi-quartin. I thought
Yes.
this
No,
stuff was terrible. So hooray!
It's
It's the general case that are we now at the situation where the markets are so fragile
yeah.
because this number
That
of
was-
bank collapses since 2008, they are fragile,
Yeah.
that the only things we can do are a very narrow number of things, because they all have to be dedicated to keeping this fragile market, this basically upside down pyramid, from toppling over.
Yeah.
I mean, the financial market should be a pyramid on its base, so it's
Yes,
big and steady. But we now have one where it's basically teetering on its pointy end the whole time. So everything has to be for that. And that, I think, is the problem.
Yeah.
And we need to understand why we got there and why it's persisting. And sorry.
No, but I'm just going back to something. I mean, this might be totally off track, but going
The whole
back,
thing's been off track. Ian.
Yes, I know. I realise that. I realise that. But I mean, looking at the little I know about someone like Credit Suisse, now they've been forced into. It's this idea of kind of like, oh, they bailed out, and actually, you know, these companies have gone bust. They're still trading. They're still there. There's a lot of them that. So Credit Suisse, you imagine their share price is zero, and then now they've merged with UBS. UBS had problems years ago, but they fixed themselves. But now they're sort of saying that the merger is going to take up to 4 years, which I kind of understand because, as we were saying before, a lot of big banks, they do things. UBS don't want to take all the risk. But I don't understand that side of it.
Well,
Is that something I should just go, don't worry about that?
no. I think you should worry about it, because when they say they've merged, it's that's not some kind of magic thing. I mean,
It's a shotgun wedding.
It is a shotgun wedding, and also whatever was wrong with Credit Suisse is still there. I mean, if they had lots of ill-performing loans, or if I mean, there was a change in the markets, and they were having to sell things, and it didn't look good for them. So you can always make the excuse, well, it was a short-term thing.
Yeah.
They couldn't meet their liabilities at that moment, so they would have had to have closed the door. That would have led to the whole global system falling over. So it's not that the bank is fundamentally not working, but it couldn't absorb that shock on the day. Well, okay, maybe, but you do have to ask why one of the G-SIFIs that's that big, that prudently run by the cleverest men in the room,
well, there was
and the cleverest women in the room, how it could get to that point.
Yeah.
So it's a pyramid that should have been sitting on its
firm base. Yeah.
Somehow was flipped on its head and was wibbly and wobbly. And whatever the wibble wobble causes were, they haven't gone away. So it'll be interesting to see whether they do the time-honored tradition of creating the bad bank, where they then
load everything that's bad into it, and then expect somebody to fix it, bail it out, taxpayers' money.
Yeah, and then say, oh, well, you know, we've got the bad bank will slowly unwind all of these trades.
Yeah.
And they use phrases like this as if it's some kind of magic.
Yeah.
And it's not. I mean, I think, which is it? The Chinese banks, I think it was in the 90s somewhere, they had virtually all of their big banks fell over, and each one of them had a bad bank created for it.
Right. So they can put all their
laundry. Yeah. And then those bad banks were still in existence well over 10 years later.
Yeah.
And then at least one of those bad banks started engaging in the kind of bad trades that the original bank, and then it went bust. And they had to create a bad bank for the bad bank, and on it goes. I think the system, you either have to think the system is fine, but just things keep happening, and then we have to fix them.
Yeah, we don't know.
Or there's something systemically wrong with the system, and that we're not really fixing anything. We've just got a system which is so broken that it constantly has to have money poured into it. But for some reason, it suits somebody, so they don't want to change it. And I think that is a more likely explanation. You know, we've had, since 2007, we haven't had any banking stability, really.
No.
Because the central banks brought in 2008 their temporary and extraordinary measures, the special tools, but they were temporary and extraordinary. Well, they certainly were extraordinary, but temporary,
Yeah.
they're still there from 2008. That's a long time.
Well, we went into austerity after that, and that's just
But that was
prolonged the.
but even then, central banks were still buying corporate bonds.
Yeah.
Well, before 2007, that's not something they did. I mean, I think the Japanese central bank now owns some massive percentage of the entire stock market, of all of their ETFs, exchange traded funds.
Yeah.
That's not a financial system that in any way looks like the financial system we had up to that point. You know, the kind of financial system that economic students are still taught about in textbooks.
Yeah.
But that's gone. And these extraordinary measures, the fact that we have the bank term funding program, is another bailout. It's more public money going into saying, yeah, we're going to buy those assets, we're going to lend you loans. You know, that one, they'll give them a loan for a year, and they can pledge all this collateral, which is basically their holding of loans and other bonds that the bank has. And they're accepting the par. In other words, they're not saying what's it worth today if you had to sell it, mark to market. They're saying, well, what is it that you bought it for?
Yeah.
That's like you buying a car, driving for 10 years, thrashing it, and then you get in trouble, and someone says, well, I'll give you a loan, the value of your car the day you bought it. Well, geez, that's generous. Thanks. Right? That's fantastic. Well, that's what they're doing. And the fact that is just the normal kind of thing and has been going on, I'm not sure there's more than a handful of years since 2008 when banks haven't been buying corporate bonds. And they weren't up to that point. So we've got to the point where this seems like the new normal. It's not normal.
But why aren't we talking about it? I mean, obviously, I know why we're not talking about it, because you're saying there are certain people that are quite happy with it and it's working for them. But it's, I mean, as a system that should be working globally, I know there's differences between European and American sort of cogs in the wheels, but generally it's not working. I would sort of say it's not really working if it's going to crash every 8 years, 10 years, and I've run out of gaffer tape.
Yeah, exactly. And we have to have almost endless austerity in order to keep it going. Well, so in some sense, it is a new system. This is the new normal, but it's a very bad normal, and it's being passed off as something else, as if, well, these are just this is just the way the world is. Well, no, this is the way the world became once we set up a global trading and financial system the way we have set it up. And it doesn't have to be set up that way. But we don't seem to be having the discussion saying, well, maybe this is a crap way of having it set up.
Maybe we can change things. Maybe we can fix things. So going forward to 2024, you can't predict what's going to happen. What should we be doing?
Well, the thing is, fixing the financial system is like fixing global warming. It's all very well saying, eat less meat or switch your light bulbs off or turn the heating down. These are good things for the ordinary person to do.
Yeah.
Are they going to fix the system? No, they're not enough. Yeah. You need massive things done at a government and intergovernment level. And in the financial system, it's the same way. We're just hobbling along with the system which constantly needs money put in. Since we've spent this entire time slightly off topic, I think necessarily you just need to raise these things. But I go back to a man called Andy Haldane, whose name will be familiar to a lot of people. He worked at the Bank of England. I think he was the chief of risk at the bank at the time during the crisis. And for my money, he was without a doubt the brightest person in the bank.
Yeah.
There may have been other bright people in the bank I never knew about, but of those I knew about in the bank, he was head and shoulders cleverer than everybody else. Yeah. I always wished he had been in charge instead of Mervyn King.
Right.
I don't know Mervyn King. He might be a lovely man. I'd have met him.
Yeah.
But I didn't really rate him, and I still don't. Andy Haldane was great. And a couple of the papers he wrote, there's one he wrote, and basically he looked at and this was quite early on, it was like 2010 maybe,
Yeah.
what the Bank of England's model was saying about the cost of the financial crisis. And he was saying then
Yeah.
that the immediate cost to the British taxpayer was about £1.4 trillion.
Wow.
That's a lot of money.
Yeah.
Okay, and that was a bigger number than appeared, as far as I know,
Yeah.
in any of the newspapers. And then he said, and if you look forwards, if you project the model forwards and build in the earnings that we would have had the economy not crashed. In other words, if the economy had been on an even keel and the financial crisis hadn't thrown everything upside down, and you say, well, those are money that we would have made, but we're now not. So in other words, looking at the difference between the austerity Britain that we lived in versus the one we would have had if we hadn't had a banking system so crapulous that it bankrupted itself and us, it quickly ballooned to above 3 trillion. And that is the cost.
Yeah.
So when they say, oh yeah, but the bank's paid it all back and it's all fine, it didn't cost us anything, that's an outright lie.
Yeah.
That's just not true. And since that paper was written and those figures, we've had several other crises. I mean, I think one of the last big bailouts was in 2019, and that one got very little press.
Yeah.
And here we are, bailing out more banks and having more low interest rates. We had a decade of almost zero interest rates, or 0.1,
Yeah.
0.2. And that's just not normal. And it created the problems we now got.
Well,
I mean, that's a topic for another day, but a lot of what has unrolled, and certainly when pension companies start getting in trouble, that was predictable. It was predictable because when you've got very, very low interest rates, don't forget the basic equation, because as my friend Jonathan always said, when you strip away all of the complicated terminology, banking's simple. It's money in and money out. That's it. There's two columns and they have to balance.
Yeah.
And when they don't, everyone makes up lots and lots of words. But what we'll come to maybe in another one is if you've got very, very low basic interest rates,
yes,
the pension companies are still promising people that their pension will deliver about 8% growth.
Yes, no, that's true.
How do you make up the difference? How do you do it? If the safe investment in some government gilts is giving you virtually nothing, and you're promising that you put in your pension money and it'll grow by 8% and you'll be able to retire wealthily. So what has happened since 2008, when we've had these extraordinarily low interest rates, is it's forced the pension companies to do more and more risky things to try and make up that gap.
Well, let's talk about that in the next podcast then.
Yeah, well, let's try and stick to the point in the next one. Cheers, mate. The main thing I hope, apart from people actually listening and getting something out of it, is if people would like to comment and offer their own thoughts, then we will pick up on those comments and in a podcast we'll actually address them and discuss the points that other people raise. It would be great.
Thank you, David.
Cheers, Ian. See you on the next one.
Bye.